Hi everybody, welcome to another update on the stock screener. Today we are going to talk about Soma Gold. The stock has been doing very well. Today it's down a bit due to the great jobs numbers. So gold is down a bit, but I think this stock will keep on rising. Now there has been some chat about the costs, about the earnings. Why does Soma Gold have negative earnings or almost negative earnings in 2022? So that's what we are going to talk about right now. Basically, Soma Gold 2022 is not Soma Gold 2023. And here are the reasons why. First of all, they had a gold loan. 12%, 6% of the revenue that needed to be paid as offtake. That is now paid off. So that's the first change. 2022 difference with 2023. That's already huge. Next up is they were mining from the old mines, Laie and Mangos. So those are now closed and there were closure costs on that. So that's another cost that is gone. Next up, they were constructing a new mine, so Cordero. Now it is commissioned, so those costs are also gone. You know, there are development costs involved in underground mining. So those costs are now gone. So that's another reason. They were also creating a technical report, and you need to pay consultants to do that. Those costs are also gone. So we have the technical report, and that's another item that's gone. Gold prices, also important. It was at 1700 last year. Now it's at 2000. So more revenues are coming. The grade is higher. Cordero mine has a grade of 8 grams per ton. The old mines had a grade of 4 grams per ton. So that's a double in grade. Okay, so people are not taking into account that the grade is now double. Production tonnage is higher. As they go into Cordero, they are going to increase the tonnage from 10,000 tonnage per month to 14,000, and it's going to go much higher because their mill is only at 60% capacity. It will go to 100% capacity. So growth in tonnage, all-in sustaining cost is lower because of the grades and because of the production and all these costs that are gone now. So that's why AISC is lower. They're also going to add some artisanal miners later this year. That's going to add more tonnage. 5 drill rigs are going to expand resource. That adds value. So now they have enough cash to increase the drill program. They transitioned to mechanized mining. That's low cost. So a lot of changes are happening. Refinancing, that's going to happen next year. I think the interest rate is around 12%, but compounded it's 15-20%. So that's a huge interest that they need to pay on the debt. That's probably going to be refinanced, and the debt is going to be repaid as well from July. So as debt goes down, interest payments go down, and earnings go up. So these are the reasons why we have net losses here, but huge profits here. And I will show you this with a calculation. But first of all, just look at the EBITDA. EBITDA is they're going to produce 40,000 ounces per year. 2,000 gold, 1,000 AISC. So that's about 1,000 margin, right? 1,000 times 40,000 is 40 million. That's the EBITDA. Market cap is the same. It's also 40 million US dollars. So we are trading at 1 times EBITDA still. Plenty of upside. Now, why is the stock not up? Okay, so there are other costs, of course. We still have the debt. We still have the interest payments. There are taxes that need to be paid. So what I'm going to do is show you the free cash flow. So EBITDA is not that important. We are looking at the free cash flow. And what's that? We deduct CapEx, all the costs, SG&A, interest payments also need to be deducted. So if we deduct everything, then we get this chart based on these production numbers and the AISC. So at 2,000 gold, we should be at 5 times free cash flow this year at 130 million. So that's a double if we go to 5 times free cash flow. So that's the upside right now. Using these numbers here, 35,000 production this year, and they're going to hit that, minus these costs, AISC of 1,000. It's going lower, by the way. And we also deduct the interest payments of 4 million. So that's for this year, a double. And for next year, it's going to be a triple to a quadruple, probably a triple because we're in Colombia. But you can see that there's a lot of upside at 2,000 gold. And we are also going to expand the mill. We still have permits to expand the mill, double the capacity, and that's going to go to 70,000 ounces of gold. So the upside is then probably fivefold. Yeah, fivefold easy. And also look at this line here. That's 2022. You can see that in 2022, the line is below zero. And that's why we had almost a net loss in 2022 because of these interest payments, because of the production that's lower, because of the AISC that was higher. So that's why we were in net loss territory. This year is different. This year we go here. We are going in the positive now because all of these things that I discussed here, and it's going much higher in the coming years. So that's on free cash flow. I also added another sheet, an even better one, and this is based on net earnings, because here we are adding the tax rate in Colombia. That's 35%. So how did I calculate this? I calculated the everything cost. I call this the everything AISC. I deduct CapEx, SG&A, interest payments, income tax, and operating costs. So I won't bother you with these formulas, but as you can see, it's the 35% tax rate in Colombia. And then with revenue minus operating cost, etc. So that's the income tax. You add all the costs, so total costs per year, and then we divide this by the production ounces, right? So that will give us the everything AISC, and yeah, so this should give us an idea about the net earnings. So I put all the formulas here in one super big formula, and then we can play with the numbers. So 2022, we were deep in the negative, as you can see here. No earnings at all. 2023, we are in the positive all over the board up until 1,500 gold. So we are pretty safe. I think this company will be profitable even at 1,500 gold. Then for next year, it will go even higher and then even higher. So currently we are trading at around a PE of 4. That's already a very compelling valuation to buy, and a PE ratio of 2 for next year. So there's upside to a PE ratio of 5. And then here, probably we go to a PE ratio of, what is it? Yeah, probably 1.5 PE ratio. There's plenty of upside when we go to 70,000 gold production. And huge leverage as well if the gold price goes up. For example, if we go up 10% in gold from 2000 to 2200, then the chart goes from 150 to 200. So that's an entire market cap of 50 million, right? So that's a 10x leverage to gold. 10% increase in gold gives us 100% increase in valuation. 10x leverage, okay? So if gold goes to 3,000, you already know what will happen. Then we are somewhere here. That's 400 million. So a lot of leverage, right? We can also try to play with the numbers. So let's say they pay off the debt. We know that they pay off the debt from July. So I think by next year, we should be able to go to 2 million interest payments. And you can see that the chart moves higher. So by next year, the 70 million market cap would go here to 160. That's more than a double, okay? And a year later, they will pay off all the debt or refinance it. So 0 interest payments. And then we would have an upside of 173. That's more than a double, 2.5. If the gold price goes up, could be a triple, okay, to get to a PE of 5. So plenty of upside as they pay off debt. Let's put it back. Now, how much capex can they add on to this? Let's say they want to drill a lot more. They want to expand the mill. Let's say 20 million. It's not too bad. There's still upside if they increase the capex. Still, yeah, still a double for next year at these gold prices. But the capex is for this year is around 6 actually, but I added some safety to it and made it 10. Total capex was around 6. With some drilling, 3 million. SG&A, okay, this can go up as well if labor costs go up, but I mean, this is not a lot. It doesn't change a lot. The most important is the production. Production has the biggest effect on the valuation, and the gold price. If the gold price goes up, it also has an effect on the valuation. Tax rates. Let's say Colombia is going to increase the tax rates. We all know that they will probably do it. So let's say 40%. What will happen? Not a lot. We are still at fair value here and upside of double. Let's take 50% tax rate. Okay, then we could drop a bit, but for next year still almost a double. Well, not a double, but maybe 1.5 upside. If they tax 70%, which is unthinkable, then there is downside risk. Yeah, if they tax us 70%, then there would be downside. And if they tax us 90%, yeah, then all the companies would be bankrupt. And if they just take all the money that we produce, you can see that we cannot make money at any price, of course. So the formula works. Yeah. Can also play with the all-in costs. If we go to 900, then the curve shifts up, more upside. 800 goes up. Yeah, we have played with all the numbers. Production, yeah, we know the production. So this was just to show you that Soma Gold has completely transformed. It has transformed from loss making to huge profitability. And that's what I wanted to say. And I'll see you in the next video. Bye.